In this era of market uncertainty, low returns, and volatility in the global fixed income market, Asia's local currency bonds can offer better value, stable returns, and diversification. Last year was a solid year investing in Asia's local currency bond markets.
Most investors in the bond markets this year will be very happy. As we can see that we do have some good return in the region that outperform the US Treasury. Our AUM in Hong Kong dollar bonds have been growing over the years. That indicates that there is some natural demand for Hong Kong dollar asset. But I have to say that I would wish to see the demand even higher. If the Hong Kong dollar bond yield is the same as US dollar bonds, I would naturally go for Hong Kong dollar bonds.
The Hong Kong dollar market for us is obviously a very important market, and I think it is for all asset owners who have local currency liabilities. That creation of liquidity, I think, is very, very important because it begets more and more liquidity by definition. The other thing I think which would really be a huge support would be to get a greater diversity in terms of issuers coming into the market.
It's a chicken and egg problem. We love to issue more, but there's not enough investors. But then from an investor's perspective, as Ben said, there are not enough issuers in terms of the breadth, in terms of the tenor.
Across the board, I'm thinking the type of investor that we got, they're all investment grade. I don't have, at the moment, I don't have any Hong Kong dollar based portfolio that allow us to invest into high yield significantly.
The impression is that, the correct impression, I suppose, is that it's pegged to the US dollar, so there's very little currency risk. So in a perverse way, there's maybe less opportunity in the market.
There's a minimum currency requirement in Hong Kong dollar exposure of 30%. I'm thinking think outside the box, like if they can put a guideline with 30% limit on currency or minimum exposure requirement on Hong Kong dollar, can they put a minimum requirement for Hong Kong dollar bond exposure in the guideline?
What that means and will mean for Hong Kong is for insurance companies such as myself, we have a lot of Hong Kong dollar liability. We're writing Hong Kong dollar insurance policies. We would have a very, very clear preference to hold a Hong Kong dollar asset in that currency with a similar duration. We want to buy a 30-year bond. We want the issuers to come into the market. We want to have that breadth and diversity. We would love to see offshore issuers coming into Hong Kong, issuing Hong Kong dollars as well. For the
Hong Kong dollar based portfolio, actually would like to see up to 30 years. We do need longer dated, like 20-year, 30-year maturity for investment. Okay, so in terms of maturity profile, we do need it. The good thing is, like, once you issue the benchmark bonds in the long-dated one, that will give a reference to the market. When they issue, they can have a benchmark for reference.
Challenges are aplenty in the Hong Kong dollar bond market, but so are the opportunities. With issuers and investors, plus the regulator working to promote its development, the future looks promising.